One big, beautiful bill has now officially been signed into law by President Trump. Today's video is going to dive into the tax implications of this bill and what that means from a tax perspective. So, this bill has a lot in it, but we're strictly focusing on the tax items. All right, first and foremost, this bill makes permanent the Tax Cuts and Jobs Act. So, for those who don't remember, back during Trump's first term in 2017, the Tax Cuts and Jobs Act was passed. And this created some very important items, such as the QBI deduction, the bonus depreciation, expanding the tax brackets, significantly increasing the standard deduction. These are a few of those items that will be made permanent. Now, the next item that I'd like to discuss is this QBI deduction, this Section 199A deduction. The way that the QBI deduction works is if you have business income, if you have self-employed income, whether it be from a partnership, maybe an S corp, maybe a Schedule C as a sole proprietor, well, this income, if you have a business net income, let's say we have 100,000 in net income, we would get a 20% deduction on our tax return. So if I had 100,000 net income from my business, I'd get a 20% QBI deduction. So therefore, I'd only be taxed on 80,000 as an example. So this QBI deduction with the new bill is actually being increased to 23%. So this is a bump on that QBI deduction, and this is great news for anyone who's self-employed. The next item I'd like to discuss is the auto loan interest deduction. So, for individuals who own a personal use vehicle, okay, so this wouldn't be for businesses since you're already able to deduct a business vehicle on your business return. This would be for individuals who have a vehicle and they have an auto loan and they're paying interest. If the vehicle is 14,000 pounds or less, which should be most personal vehicles, and if the vehicle was assembled in the US, then you're going to be able to deduct your auto loan interest. So this is great. This is a way to kind of incentivize purchasing vehicles. So this is a new item in the One Big Beautiful bill. Another item are the Trump accounts. The Trump accounts are new savings accounts for children. And the idea is that if your child was born between the years of 2025 and 2029, so 25, 26, 27, and 28, if they were born in that period, then the government's going to give your children a $1,000 deposit into their Trump account, which will be invested in index funds or mutual funds. And then you, as their parent, can contribute up to $5,000 per year. And the idea is this account will grow and grow. And then by the time they're 18 and college age, they can start distributing that account for college, or they can actually distribute even for a first-time home purchase. So we've done a video on the Trump accounts, and there will be more information to come in the future. But this is a very great starting place for new children, kind of get them off on the right foot. So we like the Trump accounts. We're interested to see how this will roll out and how this will all work. All right, another great item is the no tax on tips. This will be an above the line deduction, and it will allow people who are in the industry where tipping is common to take this deduction for the tips they receive and not pay the federal income tax on those tips. However, they will still be subject to the payroll taxes. So that Social Security and Medicare tax, that will still be, taken out of your paycheck when you report these tips on your payroll. But you're going to be able to take this deduction on your tax return to essentially avoid paying federal income tax on the tips. Now, an important note is this is for people who are in the tipping, the industry where tipping is common, right? So a business owner cannot reclassify, $25,000 worth of their business income as tips to get this deduction. That's not going to work. This is for people like servers, valets, people where tipping is a common form of their compensation. One thing to mention on the tips is this expires at the end of 2028. So this is just temporary, 2025 through 2028. The next item is the no tax on overtime. This is similar to the no tax on tips. It's temporary, 2025 through 2028. And the way it will work is if your modified adjusted gross income is less than 150K and you file a single, or less than 300K married filing jointly, then you will have no tax on overtime up to 12,500 if you're single, or 25,000 if you're married filing jointly. So, um, if you're working crazy hours and you end up with $40,000 in overtime pay, then not all 40,000 of that will get to avoid the federal income tax. Only up to either 12.5 if you're single, or 25,000 married filing jointly. So just an important thing to notate. However, this is still a great tax cut for those who are receiving overtime as compensation. Another pretty awesome item for those who live in states that have high local taxes or state taxes. Maybe you pay a lot in your property taxes. Previously, on the itemized deductions, if you weren't taking the standard deduction and you were itemizing your deductions, you were only able to max out your taxes at $10,000. So the state and local tax deduction was was capped at 10,000. That's being expanded now to where it's capped at 40,000. So this will allow more people to have the opportunity to itemize their deductions if you're in one of those states where you're paying a lot of state and local tax. So this is huge. For those of you who are paying, let's say, property taxes, let's say you're paying 20,000 in property taxes, and then you've got your mortgage interest, you've got your charitable contributions. If those items add up to more than the standard deduction of 30,000 for a married couple, then you can potentially itemize now. And in the past, you may not have been able to because you weren't getting to take advantage of the full state and local tax that you were paying because it was capped. So this is great news for anyone who is paying a lot in that state and local tax each year. All right, another item is the bump for seniors on their standard deduction. So, unfortunately, the no tax on Social Security did not make the final bill. This was something that Trump had mentioned that he was pushing for, but unfortunately, that didn't make the final cut. So instead, seniors will now see a bump to their standard deduction, 65 plus. And this is temporary. This is from 2025 through 2028. Uh, and so this is going to be there for seniors, should help give a little bit of relief there. But unfortunately, the Social Security would still be subject to tax potentially. All right, another item is the child tax credit is now made permanent at the rates that they were at. So pre-Tax Cuts Jobs Act, the child tax credit was $1,000 per child. With the Tax Cuts and Jobs Act, that increased, it doubled the child tax credit to 2,000 per child. And now it will be 2,200 per child, and it will adjust for inflation moving forward. So this is great news for those of us with children. You'll receive more of a credit because that was set to revert back to the 1,000 at the end of 2026. So you're really seeing about a $1,200 per child net increase here in the child tax credit. So that's great news. Now, the other item I mentioned towards the beginning of the video were things like the standard deduction and the tax brackets. So with the Tax Cuts Jobs Act, the tax brackets range from 10% all the way up to 37%. Those are now made permanent. That's great news because those would have potentially gone back to pre-Tax Cuts Jobs Act and been a little bit higher. And the standard deduction was significantly increased, so that's going to remain where it is at the 15,000 per person, or 30,000 for a married couple, and that'll continue to adjust for inflation each year. So that'll continue to increase. Another big item is the estate tax. That's going to stay high. The exemption, that is, the estate tax exemption is going to stay high. It'll be at 15 million in 2026. So what that means is, for someone who passes away, if you take all their assets, their home, investments, retirement accounts, bank accounts, life insurance, if those things add up to 15 million or less, there's no state estate tax. Whereas if you're above the 15 million, your estate would owe the estate tax. So that was set to revert back pre Tax Cuts and Jobs Act. So it was going to significantly decrease. So this is a great um, This is a great part of the bill for those who have larger estates. The QSBS exemption expanded. So this is the qualified small business stock exemption. So for someone who has a C corporation stock and it's a qualified small business, this has been expanded, which is a benefit if you're selling your QSBS. You can potentially recognize a lot less and potentially no capital gain on the sale. So this has been expanded. So this is great news for certain business owners out there. All right, something that has been curbed and will now expire from this new bill is the clean energy credits. So this is going to start phasing out like the wind, solar, electric vehicle tax credits that were in the 2022 Inflation Reduction Act. So this new bill starts to kind of phase those out. Um, and make those credits eventually go away. So, something I wanted to mention as well. All right, these are the main highlights from the one big beautiful bill from a tax perspective. So if you found today's video useful, interesting, please give us a thumbs up, leave a comment below if something wasn't explained well, and I'd love to respond back and make sure everything is extra clear. And again, we appreciate your time. If you enjoyed this video, give us that thumbs up and consider subscribing to our channel. Thanks so much.